method. Sorry. Daniel has two designations, a certified financial planner and a chartered life underwriter. And he's the director of financial planning and a wealth advisor at Sierra Pacific Financial Advisors. And he has over 20 years of experience in the financial planning industry and enjoys using his extensive financial planning and investment knowledge to help clients achieve their financial goals and dreams. Daniel has a wife and 3 daughters live in Livermore, and he enjoys gardening, raising chickens, and he is also an avid home brewer. And he was also once was the the business owner of the gift brewer and winemaking in Livermore. Okay, so without any further ado, I will pass the mic to our guest speaker, Daniel Goodman. Daniel.
Thanks, Yoon. I appreciate that very much. Thanks for the introduction. So hello, everybody. Thank you for coming up this morning. We very much appreciate it. So today, as you can tell from the slide, we're going to talk about concentrated stock positions for professionals with equity compensation rewards. So let's get started. So there are many different types of equity compensation that can lead to concentrated stock positions. So here on the screen, we have a few of the most common that we see in our practice. And each has its own unique vesting, tax, and sales rules, which are considered when we develop a diversification plan for our clients. So if your firm has given you stock grants as part of your compensation package, and you wish to learn more about them, you can always review the webinar we hosted last October on equity compensation strategies. If you just visit our website at www.sierrapfa.com and go to our blog page, you'll be able to see the presentation that we did when we went into these options in depth. So our agenda for today is the first thing we're going to do is talk about concentrated stock challenges. So what are the things we have to overcome both as investors and advisors when we're dealing with concentrated stock? Then we've got a 3 diversification strategies we're going to share with you and talk with you about. And then we're going to look at a couple other alternatives that you can do when you have some concentrated stock positions. So what are the challenges? So the first one is undiversified risk. So with concentrated stock, a decline in that single holding can devastate your plans, whether it's, you want to buy a new home or you're getting ready for retirement. For those of us that lived through 2007, 2008, getting ready to retire, we know how that went. So this means there's many more years of work to recover what you lost. The second is when you have low cost basis, and that gives you a high potential tax liability. So congratulations, you bought low and now you're selling high. However, selling your appreciated stock to diversify could generate a substantial tax bill. Next is, which is kind of off number 2, is the tax tail starts to wag the dog. So we have an investor who makes no moves to diversify, nor do they make any other risk management moves because they fear taxes or they might make a mistake leading to higher taxes. And we do see that with some of our clients as well. And then the last option is the fear of missing out, the one we're most familiar with. So in this one here, the investor knows they own too much of the stock, but they're going to hold it anyway because they're afraid they're going to miss out on an ever rising stock position. So how do we address some of these issues? So the first one is what we call a comprehensive sales plan. So the idea behind a comprehensive sales plan is to be both tax smart and unemotional. So the investor is going to decide how much he or she wants to keep. The duration of the sales strategy could be 3 months, 6 months, a year, whatever. And then which tax lots they want to sell. So a quick definition, a tax lot are the shares that you purchase on a particular date for a particular price. So for example, today, let's say you bought Acme Anvil Company at $10. Next week, you buy more shares of Acme Anvil at $15. So you have 2 tax lots. You have the one for today at 10, and you have the one that you bought last week for 15. Those are your 2 tax lots. So once you've decided how much you want to keep, the duration of the sales strategy, and what lots to sell, now it's simply up to execution of the strategy. So the first thing we want to do is we want to order our stock by those tax lots with the highest basis stocks first. So these are the ones you paid the most for. And when we do that, if there are tax lots with losses, these are the ones that should be sold first, because these are going to create a capital loss bucket that you can then use to offset any capital gains that you might generate through this process. Next, after you do that, those stocks that are held for at least 1 year, so you get long-term capital gains treatment, that's what you're going to sell next. And the investor will sell the lots with the smallest gain. So that's why you order these things by tax lot. The investor is then going to be able to offset those capital gains generated by the losses they created in the first set of transactions. When you do this strategy, this is going to help to manage that capital gains tax while also creating a structured and consistent method to diversify your concentrated stock position and take that emotion out of it. To kind of close the loop on that sales plan, we have this direct indexing program. And so basically with traditional indexing, which is, you buy a mutual fund or an ETF, the investor buys that single fund, and then the fund manager invests the money and they manage it in that index fund, say the S&P 500 or domestic large cap fund, whatever. Now, since you only hold the one thing, that fund, there's little opportunity for tax loss harvesting. But with direct index investing, the investor actually owns all the stocks that make up that index. So this creates a significantly greater opportunity for tax loss harvesting among all the stocks that are held in that portfolio. This tax loss harvesting strategy then helps to reduce any tax obligations that were generated from selling shares to reduce the portfolio concentration when you executed the comprehensive sales plan. So this will also help to reduce the investor's exposure to that concentrated company-specific risk and moves them toward a more diversified and more tax-efficient portfolio, which is what we as advisors are really telling our clients, this is what we want to do, is how we're going to help you. So this slide here really talks about more, kind of put some numbers around what we've just talked about. So as I noted in the prior slide, by executing a tax loss harvesting strategy within a direct index portfolio, the investor can offset any capital gains that were generated by the comprehensive sales plan. So in this example, the investor has a single stock position valued at $5 million. So if he or she were to sell that whole position, assuming an all-in tax rate of 23.8%, they would generate $750,273 in taxes. So during that first year, the direct index portfolio, they could offset somewhere between 8 and 16% of the capital gains due to the transaction from a concentrated stock to a diversified portfolio. So basically what this means is, yeah, we generated $760,000 in tax to get into the direct index program. During that first year, depending on how much capital losses there were within the index, we're going to be able to offset by either 8% or 16% because of the capital losses we generated to offset the tax generated when we first got into the position. And I'll pause right there and see if do we have any questions from our participants yet?
Two questions actually regarding the sales of the equity compensation. So the first one is, I have different type of equity compensations. If I want to liquidate some positions, which one do I sell first? ESPP or RSU, more in a tax efficient manner? And then the second one is, how to sell stocks in a sequence to get favorable tax treatment? So it's just asking what's the best sales strategies in general in a tax efficient manner.
Okay, so it sounds like there's kind of a two-part question. First is, if I have a combination of RSUs and ESPP, which do I sell first? And then the second question is, how do I do that in a tax-efficient manner?
Yes, that's right.
Okay, so to the first part, the way I always kind of look at it is, once the stock is vested, and so if an RSU, it's vested, so now it's yours, or it's an ESPP and you've hit your purchase plan date and now the stock is yours, or you had an ISO or maybe a non-qualified stock option, which you then exercised, and now the stock is yours, you own this stock now. So the nature of where it came from now no longer really applies into the selling or keeping part of the decision, because the stock is yours. It has a tax basis, which is what we just talked about. It has a tax lot. So what you would do is you would still follow that same procedure that we talked about in a comprehensive sales strategy, is what has a loss, what has a small gain, what has a big gain. And then that's how you're going to walk through the process of selling, and how you're going to minimize your federal tax liability when it comes to capital gains tax. Again, this is assuming we're always talking about things that are held for at least 1 year, because that's long-term capital gains tax. And for most folks, that's a 15% bracket. If you make, I believe it's over $400,000 in a year, I believe it is, that jumps to 20%. But for most folks, we're in that 15% bracket. So that's how you would kind of set it up. Again, the nature of it, is it ESPP or RSU or ISO, in my opinion, doesn't factor into the decision at this point, because you just own the stock. Now you're just trying to figure out what's the best way to diversify away from that in a tax efficient manner. And that is, generally speaking, going to be losses for small gains, big gains. Now, of course, if you really like the stock a lot, like you work for Apple, you love Apple, and you're like, it's treated me really well, I believe in the company, I don't want to sell all of it, you don't have to. One of the things we talk about in the comprehensive sales plan was, what level do you want to keep? So just because you're going to try to diversify away from Apple doesn't mean you have to sell the whole thing. You can keep, maybe it's going to be 10% of your portfolio instead of 60%. So you can still participate in the appreciation of the company that you firmly believe in.
Thank you, Daniel. Actually, I have one more question regarding direct indexing investment. Just like you mentioned, how do I construct direct indexing investment? Do I exclude concentrated company stock? How can I enroll a direct indexing investment? Should answer this question.
Okay, yeah. How do you get into a direct index investment program? That's a great question. So basically, that's something you have to work with your financial advisor for. There's a number of broker dealers that have this particular program. Us in particular, we use Charles Schwab for our direct indexing program. The folks there are great. But there's other broker dealers that do this, that your financial advisor may be working with. If you don't have a financial advisor and you want to get into direct index investing, we're happy to have a conversation with you, and we can talk about the potential for that. And at the end of the presentation will be all of our contact information, so you can reach out to us.
Thank you, Danielle. I think that's it for now. Yeah,
okay.
Thank you.
Thank you, Ian. Okay. So the next opportunity we have for how can we kind of diversify away a large concentration of stock is what's called private placement using an exchange fund. So this is a little bit of a different animal, in that with direct indexing and the selling, you get the money, you get the stock, and now you can go run with it. Direct placement, you're actually going to have your money locked up for a little bit. So, and that's something that always has to get talked about. So with a private placement using exchange funds, at its very core is really straightforward. The investor transfers their stocks to a placement firm in exchange for a diversified collection of stocks. So for example, you transfer all of your Google, or some portion, and you get an equal value of all the stocks that are in the S&P 500. Key point here is this exchange does not create a taxable event. So in this example, after 7 years have passed, that's the lockout period. After 7 years have passed, the investor now receives the basket of stocks, the stocks making up the S&P 500, plus any gains that were achieved during the 7 years. Again, this does not generate a taxable event. So you have now taken a concentrated stock position in Google, and you have now transferred it to a diversified basket of stocks. Hopefully you've made money over the 7 years, probably 5, 6, 7% perhaps, and you've paid no tax. Now the investor owns a basket of fully diversified portfolio and can take advantage of those tax loss harvesting opportunities. And again, you've still paid no tax to date. So in terms of that lockout period, one thing I do want to let everybody know is that shareholders may be able to redeem their originally contributed securities. So if you're 4 years into this program, something happens and you need to get your securities back, you are able to do that, but you're going to get back what you gave. So if you gave Google, you're going to get Google. You're not going to get 4 years of a prorated basket of the diversified stocks. So this next slide looks a little daunting, but it's actually pretty straightforward. So this is how that private placement works. So follow along here, everybody. Here we go. The investor owns $5 million of Amazon, and she has decided it's time to diversify her risk away, and she lives in California. And that data is on the left-hand side of that slide. So she decides to sell all of her Amazon, and she invests the remaining funds in a well-diversified portfolio. So let's just assume that the cost basis is 0. So she's going to pay tax on the entire investment. After taxes, she will net a little over $3 million. After 7 years, with a 7% annualized rate of return, our investor has now earned just under $5 million. So she's made $2 million over the course of the 7 years. So that's not so bad. But now let's consider the private placement. So instead of selling her Amazon, our investor reaches out to her wealth advisor, and working together, they exchange the full $5 million of Amazon into that same well-diversified portfolio mentioned earlier. Recall, the investors paid no taxes on this transaction. So after 7 years, at a 7% annualized return, our investor receives full ownership of her well-diversified portfolio, now valued at $7.5 million. That is a $2.5 million difference over the first option. I would argue that's a pretty good outcome. Now, there are some rules and regulations related to private placement investments like this one. So we would encourage you to reach out to your wealth advisor if you have more questions. Again, we're happy to do that for you. If you don't have an advisor, we're happy to help advise you in this particular situation. So the other one that people oftentimes will look at doing, especially when they have a philanthropic desire, is they'll make a charitable contribution and they will donate cash. Some folks may even sell some stock and donate that cash if they want to make a sizable donation. This is all great. However, it's not really the most tax efficient way to make a charitable donation when you have highly appreciated stock or you have a concentrated stock position. So yes, you may take the tax deduction, but you might have created a capital gains tax by selling the stock in the first place. So the tax efficient method is to gift that highly appreciated stock to the charity. So neither you nor the charity will have to pay any tax on that transaction, and you still get the charitable deduction. There's also the idea of a charitable remainder trust. A charitable remainder trust is an irrevocable trust. So once you make the gift, that gift is now permanent and you cannot take it back. So you then gift your appreciated stock to the charitable remainder trust. You qualify for the tax deduction in the year the gift is made to the trust. The benefit here now is that during the life of the trust, it will pay income to the income beneficiary, which can be you, your spouse, your children, or some other individual. And then once the trust lifetime expires, the remaining value is then paid out to that charitable beneficiary. Cars for Kids, your church, a Boys and Girls Club of America, whatever that might be. So that's another way of being tax efficient in your gifting while also getting an income stream from whatever that investment might be. So things to think about from a taxpayer consideration is to get the tax deduction, you got to itemize. If you're taking the standard deduction, then this isn't going to really work. So you got to make sure you're itemizing. Also, you want to be aware of the annual deduction limits for donations to public charities, including donor advised funds. So for contributions of stock held more than 1 year, the limit is 30% of your adjusted gross income. So we would urge you that if you were planning to make a large donation that's close to or exceeds your AGI limit, You may carry that contribution over for up to 5 years, and we would highly encourage you to talk to your tax professional or your enrolled agent when you're going to make a gift that size. Other things to keep in mind is the annual gift exclusion. So for 2023, that is $17,000 per person. If you exceed the annual exclusion, you must file an informational return to the IRS. That doesn't mean you owe tax. It's just an informational return. You won't owe any tax until you actually go beyond the lifetime gift limit, which is currently just shy of $13 million. So that's kind of the ideas we have around pure plays on how to get rid of or how to reduce your concentration. Next up, we want to talk about like how can you use options to mitigate some risk and kind of set up a structured sell plan. So the first thing is you look at buying a put. And what a put does is it establishes a floor for the price of the underlying stock. So the investor will buy a put, which gives them the right to sell the stock at a particular price. The put option is used to create a floor in the event the stock's price begins to fall. So the investor will determine how much loss he or she is willing to take, and then we'll set up a put to exit the position at that point. Then there's a call. So a call will generate cash for the stockholder, but that limits upside potential. So the investor can sell a covered call option, and it's a covered call because you own the stock upon which the call is based. And when he or she sells the call, they are selling the obligation to sell the underlying stock at a set price to the holder of the call option, hence why there is limited upside potential. So a caller is a combination of both the put and the call. And this can create a cashless insurance position. So the money that's received from selling the call is used to offset the cost of the put. So while the caller strategy does not necessarily directly solve the concentrated stock situation, it does create solid downside protection in a down market. Additionally, or as part of the strategy, the investor could also use a covered call to create a structured way to reduce the concentration in a stock over some period of time at some stated target price. So the investor will determine at which future price he or she wants to begin selling off the concentrated positions. They can then sell covered calls at these specific prices at these specific dates. So it can be a little bit at one price, a little bit at another price, a little bit at another price, each with their own date out into the future. This creates a very structured way that the investor can divest themselves of the stock in a well-defined and disciplined manner. And again, that's a lot of stuff. So I'll see if there's any other questions that folks might have on what we've covered so far.
I have to pay tax when I sell a call and my stocks get called away.
I'm sorry. So the question was, if the stock gets called away, is there a tax implication?
Yes. So the market goes further, like appreciated further, and my stock, the sell call that call options got called away, and then do I have to pay tax?
Great question. So without getting too much into how options are taxed, there is the potential for having to pay tax on the income generated from the call. Now that can get offset by a couple of different things. One would be the purchase of a put. The other would be if you ended up having to buy the call back and you rolled the call, which basically means you buy another one. But the one that's more important, I think, is to the question is if I sell a call and my stock gets called away, what happens then from a tax perspective? You would have to pay capital gains tax on those sales proceeds. It's just like any other sale that you make out of your account. So because of that, we generally recommend for our clients that execute this type of a strategy is to put your high cost basis stock in the account where you're going to have the option strategy. because so that in the event it does get called away, now your wealth advisor should work very hard to make sure that doesn't happen unless that's part of your overall plan. But if your plan is to hold the stock, the call needs to be managed in a certain way that it doesn't get called away. But in the event that it does get called away, because you've put your high basis stock in there, that will help mitigate the capital gains tax that you're going to have to pay on the sale. So the answer to the question is yes, there are definitely tax implications when you sell a call and your stock gets called away.
Thank you, Daniel. I think that's it.
Thank you. That was a good question. Okay. So next is what's called net unrealized appreciation. So basically what this has to do with, and we don't see it as often anymore as we used to in the past, but this is when you have a 401k and as part of your investment options, you can buy company stock. So you work for PG&E, and in PG&E in a 401k plan, you can buy PG&E. So you really love PG&E, so you buy a ton of it. As you go through your career, the amount of PG&E gets bigger and bigger and bigger and bigger. So in a traditional retirement account withdrawal strategy, the employee holds that significant portion of their stock in their retirement plan. And then when they sell it and distribute it out of the plan or out of a rollover IRA if they've retired, that company stock now gets taxed as ordinary income, because we all know that's how 401ks tend to work. So that can create a significant burden on somebody because you're paying, potentially you're in a 22 or 30% tax bracket or higher, and you're not getting a chance to get that long-term capital gain rate, which is typically 15%. So the idea with the net unrealized appreciation is that it allows a significant portion of those sales proceeds to be taxed at that favorable rate. So with the net unrealized appreciation election, or the NUA election, the IRS will tax shares of the employer stock at ordinary income tax rates based on its cost basis. So that's the price you bought it for when it went into your 401k originally. The cost basis, again, is that original value of the employer stock, the amount you paid for it. This means that any additional value gained since the stock was originally purchased is not taxed as ordinary income, and instead will be taxed subject to long-term capital gains. So upon selling the company's stock, the NUA will be subject to the capital gains tax rate, which most likely is dramatically lower than your income tax rate that you're paying today. So that's kind of all the various strategies we have today. So just a little quick bite about about us here at Sierra Pacific Advisors and what we do. We are a boutique firm located in Pleasanton, although we have offices in Oakland and Pleasanton where we can meet folks. We believe in a holistic planning approach. So we do investment management, obviously, we all do that. We do retirement planning. We do a lot of that for folks, especially those in some of the high-tech companies and around in the area. We do tax planning. We don't do tax filing, that's different, but we will help you to try to look at your tax situation and see where there's efficiencies that can be gained. We also work with stock option execution strategies. So how can we maximize income while trying to minimize tax in those situations? For those folks who've got kids going to college, me being one, we'll talk about college funding and how can we do that in an efficient way. I'm a chartered life underwriter, so I love me some insurance. So we talk about risk management and what are some things we can do around that, whether it's life insurance, long-term care, disability, or something like that. Are there holes that we can help you? And are there other ways we can leverage these insurance tools? Also, there's charitable and estate planning that we work with our clients from. The Tax Cuts and Job Act of 2018 is going to be expiring in 2025. So that means that $13 million I talked about earlier is actually going to come down to something much, much smaller, potentially 5 or 6 million. So we're starting to see more and more clients who are interested in working through estate planning to try to mitigate, what could be an estate tax when they pass away. So we're helping clients get around that. And then finally, we do have a business-to-business corporate retirement solutions group as well. So we work with small and medium-sized firms to help create or make more efficient their retirement planning programs that they've got. especially since California now has a requirement that all employers with 5 or more employees must have a retirement plan. So we're seeing some real traction in that part of the firm. This is just a list of some companies you might know. These are companies that our clients work with for whom we've helped with their financial planning and their investment needs. I'm sure you recognize at least a couple of names on that slide. And then finally, at Sierra Pacific, financial literacy is definitely our passion. We love talking finance. We love trying to help people who maybe don't have a great relationship with money, how to improve that and how to achieve the goals that they want and the things that they want to get accomplished, whether it's retirement or kids or legacy or whatever. So we do offer these informational webinars on a bi-monthly basis. So our upcoming schedule is in September. So this is actually about 3 weeks away. We're having a webinar on the TD Ameritrade to Charles Schwab transition. So for our clients today that are with TD Ameritrade, we're going to help them understand what that transition to Charles Schwab is going to look like. In November, we're going to look at some year-end tax planning. So with the end of the year coming up, it's time to figure out what are some things we can do here in the last part of the year where we might be able to reduce some of that tax liability that we've generated. And then in January of 2024, we will look at some direct indexing and how that works. So we mentioned that earlier in the presentation today. So we're going to definitely take a deeper dive in January. And then March, provisionally, we're looking at market cycles. So, a booming economy, a busting economy, something in between. What does that do to your investments? What does the market do? How does that impact your life as you go through it? And if you want to register for any of these webinars, you can reach out to us at info@sierrapfa.com. We'll be sure to get you registered and on the list. So that is our presentation from today. But as you all know, any financial presentation would not be complete without a disclaimer. So here it is. All investments involve risks, including possible loss of principal. This material is for educational purposes only and intended to be of general interest and should not be construed as individual investment advice or a recommendation or a solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. So with that, I will open it up to the floor. And if there are more questions, I'll be happy to answer them now. I'm sorry, Yoon, I was having a hard time hearing you.
Okay. The question is there any requirement for private placement that you talked about?
So that kind of gets to the rules and regs of the private placement exchange and whoever is going to be doing that. Not to keep giving pubs out, but we work with Goldman Sachs for that. There is a wealth requirement. I believe it is $3 or $4 million of investable assets to be able to participate in the program. And additionally, they will sometimes disallow the exchange of some stocks if they have too much of that in their portfolio. For example, at one point, I know Tesla was something that they said, no, we're not taking any more Tesla right now. So this is why if that private placement exchange fund looks like something you'd be interested in, you definitely want to work with an advisor on that and then find out what are the requirements for that particular fund and what are the particular exclusions that may be in place.
Thank you. The one question, I think that I got to take this one. What benefits to work with Sierra Pacific?
We're really cool people and we love working with folks. Okay, but which is all true. But on a serious side, I would tell you that we are a boutique firm. There's only 5 of us. And so working with us, you know who you're going to get on the phone, whether it's me or one of the associates. It could be Yoon, as a matter of fact. She's a great planner. And we take very good care of our clients. And because we're a boutique firm, there's a lot more opportunity for one-on-one interaction and communication, which is a big thing that we believe in at this firm. So I would tell you that that is kind of the biggest benefit is the individual attention that we give to our clients. And the fact that I think we delve a little bit into some strategies that I don't think a lot of advisors do. Particularly, I would tell you that private placement we've talked about. I don't know there's a lot of advisors that do that. Plus the collar strategy, which we've used for some clients. A lot of times advisors aren't interested in that because there is some, management that goes on with those options. So it's something that has to be maintained and looked at. And so I think a lot of advisors just choose not to go to that level of detail like we do.
Okay, thank you, Daniel. How do you compare? This is regarding in general. I have a concentrated equity compensation. This market circumstances, what do you recommend to use strategies that you recommended or proposed?
What strategy do I recommend of all the ones we talked
In general,
about?
yes.
It's actually, that's kind of a good question. I would tell you it would depend on the client situation. I mean, it's like that's the advisor's favorite answer when asked a question. Well, it depends. And in this case, I think it certainly does. Depending on, is the client after legacy? Is the client after income? Is the client after tax minimization? Is the client after maximal growth? These will help us to determine which of the strategy we've talked about today would be best for that client. If I'm just answering the question kind of in a bit of a vacuum, I might say that concentrated or that comprehensive sales strategy might work the best. It's the simplest of all the ones that we've kind of talked about, to be honest with you. The most difficult part is figuring out what you want to sell and ordering it by cost basis. So it's fairly easy to set up, and it's not that difficult to execute. We've done that with a number of clients who've actually used the direct index side of that to close the loop. And I think it's been very efficient. So again, in a vacuum, I think I would say that comprehensive sales plan is probably the least complex and probably the easiest to execute. I would still recommend you work with an advisor for that. But yeah, I think that's how I would answer that particular question.
Thank you, Daniel, for your answer. Now it's at 12:12. I think that we have assigned about 45 minutes. I think this time is a little running short, so we would better just wrap up the webinar here. We have a couple more questions about like specific strategies, equity compensation strategies, but I think we would answer the remaining questions offline by contacting you directly, okay? And I want to thank everyone again for attending the webinar and being active participants. And before you leave, I would like to remind you that you might see the survey link pop up at the end of the session. So your feedback will directly actually influence our future events. Like Daniel explained, we have ongoing webinar series to be informative and educational for our clients. And we always strive to improve and provide contents that really meet our clients' needs. So please take a moment to share your thoughts, suggestions, or any topics you'd like us to cover in the future. I would really appreciate that, and that would be helpful. And once again, I would really appreciate your attendance, attending this webinar out of busy schedule, and have a good rest of the day.
Thank you very much, everybody, for coming. We appreciate your time, and we look forward to seeing you next month. Take care now.